Good morning and welcome to this week's webinar series, Investing in Disruption. I'm sorry we've started a little late. It's the joy of technology, and that's exactly what we're going to be talking about through the whole of this week. It's my pleasure to be joined by Rob De Silva as the moderator for the whole week. Rob is Head of Research for SQM, and it's a particular pleasure for us to have Rob join us as moderator because SQM researches many of the types of investments that we're going to be talking about this week. In this week's webinar series, we're going to be joined today by Heath Behncke from Holon and Craig Hobart from Monochrome to talk about Bitcoin and blockchain and the role they play as investment alternatives. On Wednesday, we're going to be joined by Dr. David Allen from Plato and Dr. James Yang from Coolabah Capital, both of whom are chief data scientists for their respective investment management firms, to talk about artificial intelligence and the way in which it's entering investment management. And then on Friday, we're going to try and draw these threads together with Cameron Gleeson from BetaShares, David Wanis, the founder of Longwave Capital, and Jerome Lander from Lander Wealth, who are going to talk about disruption and disruptive investments and artificial intelligence and the way in which they're transforming portfolio management. But before I go on, let me just advance the slides and talk a little about 2022. It's very close for all of us. And I'm sure, like me, you're hanging out for that Christmas break. But 2022 is going to be a big year for us, with the portfolio management conferences in March in Sydney, Melbourne and Perth. And then with a new thing for us, Independent Thought, which with its podcasts, its roundtables and its conference in April, is a chance for us to showcase the work that's being done by portfolio managers in licensees and the asset consultants who support them. To my mind, portfolio management at the licensee level, articulated through managed accounts, is the cutting edge of the way in which advice is being delivered. And then in June, we'll be moving on to our Advisor Roadshow. Now, if you want to ask a question, the process is pretty straightforward, and I'm sure you've all been here before. So just do be sure, as we listen to Heath and Craig today, and then our other presenters through the week, to send us those questions, and Rob De Silva will moderate them. It's now my pleasure to hand over to Rob to introduce today and our panellists. Rob, thanks very much.
Thanks so much, Toby. Since its origins in 2008, Bitcoin began the evolution of an ever-expanding universe of digital assets. Not just cryptocurrencies, but NFTs, DeFi, and a wider assortment of other variations. The last few years have seen an explosion in activity and interest in this space. Today, I have with me two experts who are going to help demystify and shed some light on this complicated but rapidly evolving and advancing field. On my left, I have Heath Behncke, Managing Director and Portfolio Manager at Holon Global Investors. Heath has, Holon Global Investments, let's get the terminology right. Heath has over 20 years in investment management, building a strong knowledge of equity markets and financial services sectors. He has worked at firms such as Azimut, Credit Suisse, Magellan, Perennial and AMP. Today, as founder of Holon Global Investments, Heath is a global equities and digital asset portfolio manager, investing in businesses and networks that take advantage of global digital innovation. At the far end, we have Craig Hobart, Head of Distribution at Monochrome Asset Management. Craig has over 25 years of leadership experience across financial services, funds management and superannuation, including well-known firms such as BT, Tyndall Asset Management and Rest Super. Craig helps to create distribution and growth strategies for Monochrome's products such as the Monochrome Bitcoin Fund. Both gentlemen will be speaking for roughly 10 minutes on the overall topic, and then we'll have opportunity for questions and answers from the audience. So with no further ado, let's start with Heath. Thank you.
Cheers, thanks Rob. So we go to the first slide. Jenny, thanks. Great. So guys, is the slide up? Great. So just to summarise what it's all about, here we've got a slide on the evolution of the web. And when we think about the web, it's been the biggest wealth creation event in the last 20 years. It's very clear from that perspective. Web 1.0, as we caused a lot of excitement around the tech wreck in 2000, and we could see that it was potentially going to change the world. We could see for the first time all this information. As we entered the internet information, things are going to change very markedly. And of course, we got very excited around the NASDAQ tech boom of 2000. Then what's very clearly evident today, we entered in Web 2.0, which is really through platforms, this read-write dynamic orchestrated by what is now the largest companies on the planet. When you think about Amazon, Google, Facebook, etc., as providing this way that we can actually interact, and some was actually called the Internet of Communication. And these companies dominate global indices today. But what started to happen is that we started to see Web 3 evolve. And what is Web 3 relative to Web 2? Well, we're able, and this really kicked off with the Bitcoin conversation. For the first time in history, we were able to actually coordinate money transfer without actually having an intermediary. So we moved from this read-write to this trust verifiable situation. That is, actually we could do automated money transfers. And this has really kicked off a much, much larger discussion, as that we can see in Web 2 today, that the key thing that we're trying, that we realise is that we're the data and we're being monetised through this sort of quasi-data monopolies in many ways. And every government around the world is actually onto this. We're very aware of it. And a lot of the solutions with Web 3 are really aimed at resolving that issue with going on. So we go to the next slide. The other thing that's happening is very clear is that things are speeding up at an exponential pace. And this graph sort of highlights, you see in the industrial age, the rate of adoption versus what actually happened in the information age there, post-2000, the advent of smartphones and cloud-based technologies. And of course, if we were to look at the Web 3 adoption, it's even been more rapid. And you can see that through the expression in digital asset markets as they've grown very rapidly since 2016. I think when I first started looking at it, there was around 10 billion US in market cap, and today they're at 2.5 trillion. And a lot of this is due to, we've learned how to digitize. We're now also incentivizing, which is a very, very important thing to actually understand, which is leading to this rate of acceleration, which looks to us like twice the rate of adoption of Web 2. Next slide. So of course, if you look at the big trends that are coming, you can see that the number of internet users will continue to grow very massively. The amount of data that we're going to generate is going to really grow quite exponentially over time. We're going to see EV, we've seen that conversation actually coming, and of course this transformation I'm talking today about Bitcoin and financial services. Mostly Australia doesn't have much exposure to this, and where things are actually heading at scale. One thing that we're sure about across the portfolio that we run, which is focused on Web 2 and Web 3, is that we're going to actually generate vast amounts of data, more data than we realise. And again, this is why the Web 3 solutions around this are very critical and important to actually dealing with what is that data monopoly issue that we actually see today. Whether it's EV, we're going autonomous takes reams of data actually to drive that equation. IoT, whether it's digital assets themselves, of course, with NFTs as we move, which is one of the greatest things that about Bitcoin was it's really solved that digital scarcity, defining digital property rights as we moved forward. And this is now being applied to many different areas. So this is the thing that we're seeing, that this is actually, these estimates are provided by an independent forecaster, IDC, but we think there will be multiples of this as we go forward. We see it right across our portfolio of companies that we're just going to be generating vast amounts of data. Slide. The big thing to understand here is that in the Web 2 paradigm, and where the money was really made is on the application layer. So think about Facebook and Google. They actually captured the data, put it into their data repositories, and they made that's where the money was made. We can see that very clearly today. And they built on this protocol layer, which is 30 or 40 years old. You can think about protocols such as HTTP, TCP, a whole range of different protocols that were put in place, and essentially they benefited. The beauty about blockchain is it allows us to actually start to develop new infrastructure and protocols where you can start to actually change that value equation, a shared data layer in many ways. And this is a very, very important concept to actually to understand. In many ways, when you look at Web3, we have new infrastructures that are being built that improve upon Web2. In many cases, very massively in that way. Bitcoin's a great example. There's others like Filecoin that Holon's absolutely involved with, the distributed storage solutions around that. And this is really the big change that's going that crypto is enabling, and a very important part of that Web3 conversation. Of course, to understand this, if you think about what's happened in the last 10 years, if you look at the NASDAQ, has delivered about a 20% per annum return, and Australia's, the ASX on the other hand, has delivered half that rate of return. A lot of that's due to that we're underweight the essential infrastructure of Web 2. And you can see this in this slide here that I've highlighted here, that the ASX tends to be very old world, very underweight communication services, very underweight information technology. And of course, when you look at the information technology and communication services sectors of the MSCI and the S&P today, it dominates them as being again, representing those largest companies in the world. This was structural in nature. This is driven by smartphone and cloud connectivity. A lot of those very, very big businesses that we see today, the underpinning them of them are cloud. And that conversation has just been reinforced by COVID. And of course, Australia has a very limited exposure to this. Web 3, on the other hand, where we think this will be really going to be impactful, it'll be quite across a number of sectors, but the main one is really going to be financial services. If you think about, we're heading from the internet of communication into the internet of value, and then it's obvious that financial services within that is likely to be in the firing line for disruption. And the key thing about this is that, you know, Australia as an economy, its largest sector is financial services. And you see on our ASX, the largest sector again is financial services at nearly 30% of the exchange. So unlike the internet of communication, where a lot of our traditional media businesses, retail, etc., were small components of the index, what you find here is that it's quite a large component of the index. And this is why people like Josh Frydenberg and Andrew Bragg have announced quite significant reforms to take place to make sure that we benefit from the utility of the technology, as opposed to suffer from the disruption as we move forward. And this is why we think it's quite critical that Australian investors are over this as we move forward. We think in some ways the disruption ahead of us is actually greater than the disruption that we've actually experienced in the past as a result of this. And Web3 and crypto and blockchain are going to be a big part of that conversation. Thanks, Rob.
Fantastic, thank you. And ahead of time, so excellent. We want to have time for questions, and we've already had one good one. I'm not going to ask questions now. We're going to have Craig speak, but keep them coming. We've only got a couple there so far, so please, if you've got any interest, and I'm sure you do, in this topic and any questions, feed them through. You'll get great answers from these gentlemen. So let me hand over to Craig to discuss Bitcoin.
Well, thank you, Rob. Thanks for the introduction, and thanks, Heath, for your content as well. I found that really informative and helpful. Monochrome is a business that's designed to do two things. I'll move to the next slide, if you don't mind. The primary issue that we're seeing in digital assets, crypto, is custody, is a prime issue. And aligned with that, of course, is education. So Monochrome's assembled a team of people with in excess of 150 years' experience across traditional assets and digital assets to bring to market a solution to this industry problem. Next slide, please. So our core beliefs are there are some issues that the industry needs to address. Custody is the biggest risk for investors today when it comes to crypto. We've seen scams, we're aware of them. Exchanges today are not regulated. Andrew Bragg, obviously his work's very important, and Josh, the Treasurer, are taking on responsibility for that progressing into legislation next year. But as it stands today, custody is the biggest risk. Self-custody is a risk. People lose their keys and wallets. There's over $100 billion worth of Bitcoin that will never be found, for example. And our business is designed to solve that, not only for wholesale investors, but also for the institutional market as well. We also, in the crypto space specifically, alpha is not yet proven. So our strategy is going to be to sandbox and look at particular signals in the crypto market and see whether there are investable ideas that can be brought forward as alpha. But in the meantime, we think that the most prudent way to access this is through Bitcoin itself in a passive spot-priced product. We also see that there are many risks in digital assets, excluding Bitcoin. And for that reason, our focus is on Bitcoin. Interestingly enough, the regulator put out a paper called a Request for Information, CP343, in July, and responded with RES 705 on the 29th of October. In that outcome, they identified that the only two crypto assets that meet a whole range of important criteria, like it's institutional, the service providers are in place, there's quality custody available, there's a spot market, there are deep futures markets, regulated futures markets, etc. There are only two crypto assets that met that criteria, being Bitcoin and Ethereum. Bitcoin itself as a protocol is very proven. It's been around, as we've discussed, for 13 years, and it's the base for this whole event that's occurring in markets. It's the base protocol. It's very proven. It has deep liquidity, and it has scale. Well, interestingly, we'll discuss this today, the issue of valuation will come up for sure. It is a non-intrinsic in the way that price is determined, as opposed to nominal valuations, which is nearly every other asset that is traded in markets. Most assets, things like equities, bonds, property, infrastructure, all come back related to interest rates in some way. Bitcoin itself is not linked to that, and we'll talk more about that later. And then importantly, our last belief is that education is really appropriate right now. We ran a survey with the advice community. 70% of advisors, 77% of advisors have had an inquiry from clients in the last 12 months. And 89% of them said to us that they felt ill-equipped to respond. That's partly education, it's partly regulation, it's partly the availability of suitable products. But we have developed a suite of education CPD content to help address that as well. We actually believe the advice industry is actually the white knight in this event that's occurring, and they will provide security and comfort and conversation with their clients going forward. So our solution is a wholesale passive physical Bitcoin fund. I won't go over this next slide, cognizant of the time that we have, but you'll see in there that we're using a regulated product. We're using our industry knowledge to determine the best way to achieve safe custody. We're using the licenses available. Interestingly enough, in RES 705, for the first time in the history of this asset class, ASIC has determined there is a way for Bitcoin and Ethereum to be issued under a PDS, subject to adjustment to licensing and providing the solution for custody, etc. And so very importantly, while we've operated under a wholesale environment, for the first time a PDS will be able to be issued and we'll be delivering that product in the new year. Next slide, thanks. Finally, I just wanted to talk about how this asset actually behaves. Very importantly, you can see in this volatility chart, we have a classic diversified product, the fine dotted line along the bottom. The volatility is very low, and then you look at Bitcoin itself, and it has massive volatility. So you really need asbestos gloves when you're picking this asset up and using it in a portfolio. And we'll talk more about how advisors in the United States that are more advanced in this asset class and how institutional investors are actually managing this volatility. Equally, in that consideration is correlation. Bitcoin is very lowly correlated with bonds. And in the last 12 months, there's been a spike in correlation with equities, which coincides with the massive market rally we've seen in equities, which has also occurred in Bitcoin. So how do you use it? Well, there's a number of conversations that can take place with advisors and with clients. The first is how much you're willing to lose, and I think that's a prudent conversation to have. Classically, we're seeing overseas between 1 and 5% is the asset allocation that's being delivered. And then advisors with their clients are reallocating back to a strategic benchmark periodically, whether it be a market review or an asset target. You can see here the impact of 5% of Bitcoin on a diversified portfolio being reweighted monthly over the long term, being the top line. And then if you have a 1% allocation, you're not materially increasing the volatility of the product or solution, but you are seeing increased returns. So that's the introduction to what Monochrome is about, and I'm happy to take those questions that I'm sure are coming. Thanks, Rob.
Thank you, Craig. That's fantastic. So we have a little bit over half an hour to just talk Q&A over this whole area, which is a massive space and not enough time. But let's do the best we can. We've got some great questions already. So let me start with one for Heath, and I'll just read it out. Will the real competition be between providers of distributed ledger technology? We saw the ASX talking about its DLT/blockchain last week. How many providers does Australia need?
So this is in regards to funds that are going to be offered, or so that's the settlement solution by the ASX?
I assume so, yeah.
Settlement solution by the ASX is probably just going to be one, without doubt. I think for providers, just like Craig, actually, Holon's looking to launch a Bitcoin fund and an Ethereum fund as well, and I think there'll be a number of providers in that area who will come out with solutions. We think it'll be pretty similar actually to what's happened in Canada, where you've had 4 or 5 providers providing products for Bitcoin and Ethereum.
Yeah. Actually, let me follow on from that answer around availability, etc., because you've mentioned that both your firms, you already have access via wholesale products or info memo products. But now that the space has opened up to retail, you both have ambitions in that space. There's also been ETF providers that have made it public knowledge that they intend to bring product to that space. Clearly, it'll be Bitcoin and Ethereum to start with, because they're the ones that ASIC have kind of given the imprimatur to. So when these retail products launch and become and develop some traction, will they change the way retail investors approach this market, and how will that change the way they do that? And this is open to both of you.
I'll take it on first, Heath, if that's okay. I think there's a few things in that question which I think we need to unpack. The first is today, for retail investors to access digital assets, the only way they can do it is through unregulated exchanges. And of course, if an unregulated exchange collapses, there is no recourse for an investor. So trust accounting and typical custody arrangements don't necessarily exist in that environment. And so between now and when the Andrew Bragg report is converted into a bill and converted into legislation, retail investors are exposed when they use digital asset exchanges. So that's the first thing that I think is important. So the solutions that fund managers are bringing to this segment are regulated. And ASIC has described the two assets that meet their requirements, being Bitcoin and Ethereum. So an investor, once they invest in a PDS, obviously enjoys the protections that come with a PDS. For example, suitable custody, trust accounting is in place, insurance to ensure that if something happens with their money that there is recourse. And those aren't afforded under the current arrangements that don't exist today. So when they come into existence, ETFs are obviously issued through a PDS structure as well. So an ETF will provide that solution, and a managed fund will also provide that. Of course, what we've done is invested in the education piece so that the advice community can come up the curve, as we all need to be able to have those conversations with investors.
Heath, anything to add?
Yeah, well, I think as Craig's saying, I mean, the biggest issue that had to be addressed is essentially you can see on exchanges today, there is, once you hand your money over, and people don't realise that they actually don't own the Bitcoin. The exchange actually has, and the exchange itself is not subject to any regulation. Of course, in financial services, asset managers like ourselves and financial planners, segregation of duty and custody is very key in that equation. So I think that's the great thing about what's happened with ASIC and Andrew Bragg and the Treasury getting behind all this is creating legal certainty. And I think this is actually one of the great things. We'll take it even a step further in Australia that because once we have very clear legal laws, that will help right across the spectrum, even down to Craig and I, we encounter this every day, of course, talking and advisors with PI, like how does this fit within PI insurance and as well, and that's very, very critical from that way. But we're basically bringing the institutional grade infrastructure to allow people to access this in a very safe way with the fiduciary responsibilities. And this is not to say that digital currency exchanges, a lot of them have been crying out for regulation. Again, that's what Bragg's actually looking to do. That's and a lot of that, they're good actors, good players. But Craig and I, we have to go offshore actually for solutions around this today, and that's what Bragg's realised that hang on, we need to be doing that part of it in our country. Very important from that perspective.
Isn't it interesting that you see, the crypto environment is one you hear a lot of talk about decentralisation, we don't want people controlling what's happening, etc., and yet the key players and the key developments are to progress this marketplace is really about having some regulation and some certainty around what's going on. Otherwise, you can't really get proper traction. It's kind of an interesting conundrum. But let me follow up on that area as well, because you talked about having more regulated products is going to be advantageous for investors, obviously. Within that, you mentioned good actors and good players. So even within these regulated products, there's going to be a spectrum of quality about the actors and players within it, the exchanges that are used, the custodians that are used, the valuation services that are used. So how do you navigate that for yourselves, and do you have any advice for people to help them kind of figure out what's what in that space?
Well, there's a couple of things in it, and Heath will obviously expand on this for sure. I think you made a very important point there, Heath, about ownership of the asset, and Rob, you also kind of touched on it about even in a regulated environment, you have good and bad players that can participate. I think the first thing is, like Bitcoin, the protocol itself is not a problem. It's the pathways into it and out of it where the problem has resided. And that's where the good players and bad players. In the unregulated exchange environment, when you buy Bitcoin, you don't own the Bitcoin. The exchange owns the Bitcoin, and they make a promise to you. The only way you can actually own the Bitcoin is to take it off the exchange and put it in your own wallet, and it's self-custody and become your own bank. Yeah. That's fine until something happens. For example, you lose the keys, or you have an accident, you pass away unexpectedly, because no one gets to choose the day if they're going, usually. That's a problem that this whole industry in itself, through the custody piece, we kind of talk about custody, but there's a number of layers in that are particularly important for people to understand. Heath?
Yeah, look, it's kind of interesting. Rob, as running a global equity fund, here I am, I've got to whittle it down to a number of names that we to deliver on the outcomes for our clients, and same thing in the digital asset space. And we take a very similar approach actually to it, and in that way, in terms of the deep homework that we actually do to really understand the ecosystem and the value propositions in its entirety. And so it's a bit like Monochrome videos. We've started the infrastructure layer, really, when you think about it. So infrastructure, we kind of think about governance for money, infrastructure for money. We're involved in Filecoin, which is, again, as I discussed, one of the things I see very clearly is that I'm investing in Google and Amazon today, and they're quasi-monopolies. No, that's a problem. And then also we've got the next version, Web3 cloud storage, which we think is a very powerful thing, enables a lot of things to actually happen, solving some of those data issues. And again, that's actually really an infrastructure piece, because everything's built in that space, ends up needs to be stored in some way, in that way. So we've done things like that. I've been involved since 2017, where you intimately involved with the groups around that, but we think that's like a sensible way to start. And this is why even Ethereum, with ASICs included Ethereum, recognizing that Ethereum has a very strong network effect and bigger ecosystem. And when you think about the digital asset space today, 2.5 trillion. One's contributed to Bitcoin circa, and the other 1.5 has a lot to do with Ethereum, because they provided that platform. A lot of things like stable coins and other things that are going on are done off that platform. So that's where we think is a sensible place to start with that, but applying the same sort of conversation around ESG when you look at these. The blockchains from that perspective, environmental, social and governance perspective is again the same approach, and look, it's all about people, so understanding people. In the case of what Craig's saying is that with decentralisation and Bitcoin, of course there's nobody in control of that. That's a very important conversation, but when you actually see the Bitcoin core developers in that community, they're very committed to what it actually represents. And that's the thing that you need to, and the governance around that and how they operate is very, very clear. Yeah. So you need to make those types of judgments and assessments.
So the audience has been fantastic. They're flooding us with questions. We won't be able to get to all of them. But let me mention a couple that wrap into one sort of broad topic, which is, how do you value Bitcoin? What kind of investment characteristics does it have in terms of the way it acts in the marketplace? Is it a real investment in the first place? So let me, and just to add some flavour to that, I've personally seen valuations of Bitcoin from various commentators, some very well known, that range from $0 to $1 million per Bitcoin. So obviously there's a lot of debate about this, and not just what is its value, but does it even merit a place in an investment portfolio, etc. Let me read just quickly some of the comments that sort of flow around that topic. How much of its value is tied to its earnings versus tied to its potential? What are Bitcoin's earnings, and how does it earn revenue? Bitcoin has a short history and interest rates have been low and markets strong. How will it perform in a portfolio when markets are the down leg? Implicit in the presentation is that crypto is a real investment. I get that blockchain could revolutionise financial services, but I haven't seen in this conversation any evidence that cryptocurrencies are a real investment asset.
Okay.
There you go.
Well,
over to you.
I think I should have first go at it, given that's the asset that we invest in.
It's the one that's very much on a lot of people's minds.
There are a few things I wanted to say to start with. I've obviously come from an intrinsic value and investing background myself, so I've had to spend 5 or 6 months getting my head around what this is and what it isn't. The first thing is it's not nominally valued, so it's not intrinsically valued. It doesn't generate any income. So to that question that was raised, it's not related to interest rates in the way that an equity is. Equity, obviously, you've got a discounted cash flow model, you've got a risk-free rate, you've got a risk-free premium. You run your model out for between 10 and 30 years, depending on your approach, and you have to imply interest rates, the cost of funding, debt funding, etc., etc. In all of those, similarly the bond market, of course, is obviously directly related to interest rates, and infrastructure and property when it's commercial property that's generating an income stream. So all of those assets are intrinsically valued in one form or another, and there's great debate about the value of those assets, as we know.
Yes.
There are those that don't see the future in an asset and those that do, but they're all using underlying, there's interest rates related to those. Bitcoin is not valued in that way. In fact, it's not valued, it's just there's a price that's derived from the market. No different to gold, for example, which is kind of the closest thing to what we've seen in the last 30 years that equates to what Bitcoin is. So that's the first thing we all have to get our heads around is actually we all believe in intrinsic value investing for intrinsic valued assets. We all do.
Yeah.
This asset class doesn't fit into that paradigm or into that framework because it's not in that framework or paradigm. So at a very base level, economics educated, supply and demand is a very important function to determine price.
Yep.
There are only 21 million coins that are going to be mined. We're at about 19 million now. Every 4 years is what they call a halving. So every block you get rewarded with 6 1/4 coins every 10 minutes today. That will halve and then halve and then halve. So the supply side's set, we can see that. That's something that is a certainty. The demand side is obviously completely driven by sentiment.
Yep.
Now, inside that, there's a couple of things that I've observed, which I think we talk about. There's a religious element in Bitcoin. Heath touched on that before. And they have tethering, like this commitment to a something. It's like a dogma. And I'm not sounding religious, but there's a religious element here that's actually valuable for us to understand what occurs in Bitcoin. Is every week, every month, there is more committed to people making dollar contributions to Bitcoin than there is supply coming online. And that's a function that's been going on for a long time. The reason I got involved in this asset class is I wanted to solve the problem of what's happening with consumers. We're seeing people getting ripped off, and I think the advice industry can supply a solution to that. And a passive product in Bitcoin is the right solution inside of that. And so what we find ourselves doing is seeing a supply function that baseline is exceeding demand. Demand is exceeding supply before the suits come into the sector. And I say that because we've seen, Macquarie's just invested in a company, CBA's invested in Gemini. We've seen JP Morgan and others in the United States actually now get on board with it per se. So this is like, if you look at the demand function for the asset, it's only what someone's willing to pay for it, but it's moving.
Yeah.
So I guess what I'm trying to say to everyone is that we don't have a directional view per se on where Bitcoin will go, but to write it off, I think the protocol's not going to break. It's one of the best protocols in the world.
So if to summarise, what you've said, it feels like what you're saying is there's no magical formula that you can put a bunch of numbers into to get the answer. Bitcoin is worth X number of dollars. You're seeing two forces. Essentially, it's supply and demand. How many people want to buy it? How many people, how much product is being provided? And the underlying forces through future is there's limited supply, and there seems to be an increasing demand from broadening investor base, broadening institutional involvement, etc., which provides, a positive future outlook, but no specific price attached to that outlook. And can I ask you, what it does seem to have in common with gold is some element of sensitivity to risk sentiment.
Yes.
And so that seems to be one aspect that has it linked to the general financial market factor called, risk on, risk off, or, fear of market risk. So do you agree with that aspect of it?
I mean, these are all, Bitcoin's proving itself through market experiences, and it still will continue to do so. There's two things inside of that. The first is because it's not nominally valued. It does have that characteristic of gold. And if we all know that all boats have risen as a result of interest rates going down, and we're all probably at some point going to be asking, when is it going to stop? If they're not asking that already, and you've seen some high-profile industry funds actually take risk off the table too early, in hindsight, because their intrinsic value models were falling short of where current valuations are. So the separation of it being not intrinsically valued, not being nominally valued, is important because that gives it that separation. Yeah. In saying that, risk on, risk off, there are participants in all crypto assets, and particularly that are chasing risk. It's a risk trade. So I think you have to look through the near term and think about more strategically, it is not nominally valued, that is a value to a portfolio. So some institutional clients are looking at it as a long vol solution.
Right.
My hesitancy is just how much risk on is inside the current sentiment that's occurring in the asset.
Yeah. Heath, your thoughts?
Yeah, look, I think when you're thinking about it, you really need to shift your viewpoint from capital value assets, and this is the issue. I think if there was actually quite a good paper done by Robert Greer, that actually really thought about defining super asset classes to actually frame things. So you've got capital value assets, you've got store value assets, and then you've got consumable transformable. Mm-hmm. And what's actually happening here, and most people who are used to in equities, is discounting some form of income stream. But of course here, Bitcoin being known as a store of value, the approach to it has to be very different when you look at it. And when you start to understand, as Craig's saying, it's just a function of essentially there's a fixed number of Bitcoin, and then it's just the adoption around that. So that gives you one sort of way to actually, lens to actually characterise it. But the value proposition of it is like the thing that's driving it. And most people are, of course, taught about money from a really Keynesian aspect. We've all been given that sort of framework. As opposed, if you actually went to the Austrian school of thought, they've got lots and lots of work done on market-based money and how that evolves. And it's more in line with the Austrian school of thought. So there's a lot of economic theory around how market-based money can actually evolve. And of course, in the world that we've seen today, we're starting to question somewhat what's happening with central banking and et cetera around that. And that's what people starting to realise, maybe over the longer term, this might be a better store of value in that way, driving adoption. And that's why the interest in that way.
And I get that argument, but that's more for cryptocurrencies, Bitcoin being the leader of that. You've got 12,000 digital assets. How do what are the merits of or investment parameters around some of those other
So I'd
assets?
say, like, to understand this again, and Monochrome is Holon be on the same page here, Bitcoin has the dominant network effect.
Yep.
And that is really, that's the key thing I look for in all the businesses we invest in, rather than equity, is that dominant network effect, right? And it's very clear with Bitcoin having that dominant network effect, right? So, and look, you might be able to find that we might have a time something may come, but we think it's unlikely. It's like trying to set up, I might set up Heath coin or set up the version of Facebook today, but I don't think people are going to adopt it. I think Facebook's in a very, very strong position in that regard around that. So I think that's the first thing it's really those dominant network effects. And again, Ethereum has that somewhat as well, of course, because of they kicked off and a lot of the ecosystem's actually built on it. But the way, if you start classifying, and I don't think of Bitcoin as a currency, I think as a digital asset, as a commodity, as a store of value, right?
Yep.
And I think that's the way it should be, as a very trusted way that we can store value actually over time. You look at its key value proposition. If you look at something like Filecoin that we're involved in, again, this is the way to, if you think about Bitcoin for a moment, the way it all kicked off is that people started to realise, hang on, I can transfer money on this protocol. So put aside the asset, I can do money transfer, without anybody being involved. And that is actually, that was the huge breakthrough, and that was enabled by the protocol, separate from the asset. Right?
Yep.
Filecoin, same thing. Suddenly, we've got a new protocol for data. We can shift away from HTTP to IPFS and rearrange how we actually use data on the internet. Yep. That's the underlying key value proposition. Yep. And again, that's would be viewed as a commodity, a utility, a consumable, transformable asset. Yep. So what you tend to when you think about the way places like Switzerland or Wyoming are starting to think about this, they've got very clear classifications so they can help get away from that currency definition of it. So you suddenly find you can classify payment tokens for actually doing transfers of money. You can classify utility tokens like Filecoin or Ethereum that actually run the actual infrastructure itself, and they've got actually a core function, a core utility in that way. So if you start thinking about it that way, under the super asset class framework, then your valuation approach will be very different than what you actually do today. And I think that's the first thing that you need to do to get your mind around.
Yeah. So essentially, the comparison would be in the equity markets, you have consumer discretionary, energy, financials, other sectors like that. Within the digital asset world, you have various sectors as well, which have their own economics, their own use cases, their own specific kind of investment merits that you've got to understand to really get a grip on how that works. Let me kind of come back to the question again around why is this an investment? And from the things that we've been talking about, let me frame something, because what it seems to me, you're talking about an asset that has some. It's not a currency. It's a store value. It has a broad base. You can think of it almost in the same way that people think about commodities in their portfolio. There's no necessarily dividend yield or discounted cash flow that you work off. It's around supply and demand. It's around risk sentiment and building, and the fact that underlying asset is going to have an existence into the future just because of its general acceptance and utility. Based on those factors, is that what you believe warrants its presence in somebody's investment portfolio? Or if there's other arguments, how would you frame that? Why should people treat this as a serious investment that they might consider for their portfolio?
Yeah, I mean, within the Bitcoin protocol, there's a couple of things that are important to remember as well. It is not owned, or it is a community asset. It's not, so reserve banks, central banks, governments, regulators can't control it. It's not linked to interest rates, so the decision about where you put your currency or issuing of a bond, all of that just doesn't matter. So there are a number of places, either first of all where people can't access the banking system, or they don't have their own sovereign currency, where Bitcoin has found a home. So it has some social purpose as well. But when you look at our prime fiat currencies, all of the currencies have followed each other since 1971. The debasing of all currencies is quite profound. And at some point, those that are right into the Bitcoin space would argue that at some point that will need to stop. And when that occurs, where is your store of wealth best served? So, some governments are talking about issuing a digital currency, but at the end of the day, it's still linked to the currency. And Bitcoin itself is designed to be separate from sovereignty. It's absolutely by design, that's its purpose. So, people are saying it's an insurance policy against Armageddon, or an insurance policy against some of these foundational financial markets and systems collapsing or reshaping. It separates itself from it. So, that's a purpose.
And for certain countries, obviously, like Ecuador has adopted it, and for other countries that have volatile political histories, that's clearly a possible avenue. It's a bit less clear in the developed world, the United States, UK, etc. It feels like in those areas the use case is more about other aspects of rather than it might replace the financial systems of all those countries, but who knows? But in the meantime, there's other utility around it. It seems to me. I mean, how would you comment on it?
Well, I mean, for me, Rob, the one thing that you see a lot of people talk about sound money. You've heard, we've been part of it. If you're in financial services, it's hard not to be part of that and consider that conversation over time. And gold comes up, in your portfolio. And the thing to me, deep understanding of financial services was very clear. You can actually build financial services around Bitcoin. It was very hard with gold to actually achieve that, right? So, and this is like, I can see this in Wyoming because we've got an investment in a bank that's doing exactly that. A bank, as you think about a CBA, Westpac, etc., who's actually custodying Bitcoin. So you can see a financial system being built around this. Now, the other thing that Craig and I are very aware of is that we can see now what's being built on top of Bitcoin in terms of there's a network called Lightning, which would be the equivalent of Visa, MasterCard. Now, I'm watching this very closely, Rob, because I've got investments in Visa and MasterCard, but I'm starting to see near instant free global money transfer happening around the world in fiat currency using the network, right? And this is an open network. So this is really critical, because if you're not over crypto and what that enables, then you're not really understanding where that next around a disruption may come from very traditional financial services as a very tangible example to this.
Yep.
Sometimes it's hard because when you look at the volatility, a lot of people can get, it's kind of, oh, hang on, this thing that moves around. So when you think what you need to focus on is the utility. What is it actually doing? And that's the thing that I'm very aware of. Just keep focusing on the utility. The very point, I find it sometimes central banks don't comment about this enough. The fact that the network enabled us to do transfers without having any intermediary is a very big step for humanity.
Yep.
And then that's how it started to get its utility.
Yep.
And then you got to remember, some people say, oh, well, physically it hasn't got any worth. Well, actually, most of my investments, I don't have much in the way of intangible assets. They're worth a lot of money because they're providing network connectivity to people. And that's essentially, if you start from that basis, because I get a lot of people when I talk about gold, or if this is the digital version of gold, it has to be tangible. But gold doesn't derive its value from its tangibility, it's from its scarcity.
Yeah.
And that's what's enshrined in the community in that way. So it's kind of, once you start walking down that pathway, you start to see, hang on, there's a probability of this coming about.
Yes.
And that's why it's really about, because it's insurance policy.
Yep.
The world could go this way, and you want to be over this. And as we're saying, we think it's vastly greater. It's well beyond Bitcoin. We're involved in building some of the aspects of the ecosystem here, where we can see quite marked shifts that can challenge even the largest companies today. Because one thing about Bitcoin, you can see this, and it started there, it's, open source economics are superb. And the way communities can, and this is really a community link globally, and that explains this rapid pace of development that's actually going on in adoption.
Let me come back to the store of value argument, because there's a couple of questioners from the audience that have expressed some scepticism around a label store of value when you mentioned the volatility, you have drawdowns of 50, 60, 70, 80%. That doesn't feel like a reputable store of value, right? So, but you've talked about other value for Bitcoin that doesn't rely on that aspect of it. And, I can understand that, but just talk on store of value.
Yeah.
How much people should really pay attention to that concept when the thing has, you've got one of the slides, the volatility is triple what equities are generally.
More than that. Yeah.
More than that, and sometimes much more than that.
Yeah, that's right. And it's a characteristic of being a nascent asset class that's trying to find its way, but that's true. And that's why we say, in our prospectus and other places, it's a long-term investment. In saying that, we also talk about that reweighting discipline. So you can trade the volatility effectively, take the top off if you have a hard run or add to it. Be disciplined around volatility as it sits in a broader portfolio. Again, though, the long-term prospect, it's why we say it's a long-term investment. I mean, it is a nascent asset class finding its way.
So can I translate that to saying it's a long-term store of value, but it's a bumpy ride along the way?
Correct.
A very bumpy ride. And that means you've got to be prepared for that. And I think it reflects back to, again, and we're running out of time, so I'm going to speed a couple of questions up. What kind of investor should think about this, and how should they think about it? Because of the volatility, because of the uncertainty in the near term, should it only be the risk-seeking investors, and how much should they have in their portfolio? I don't want you to give investment advice, but just frame it in some kind of broad perspective. Is it for everybody?
No, it's not. We do a TMD, target market determination, for the product when it's launched that will be released with it. And of course, we'll describe it the way we've had this conversation. It's highly volatile, and it fits as an allocation in a portfolio. So PI cover insurers will want to see some rules and frameworks around this asset. For example, are the advisors accredited? Do they understand what the client is asking for? Do they have asset allocation limits? We would never suggest that it should be more than a sliver of someone's wealth as an insurance policy against Armageddon, and that's certainly the way the institutional market's thinking about it as well. Education's key, containing it's key, having discipline around reweighting and revisiting the allocation. Some licensees will require pre-vetting of an allocation, as you see with certain assets today. So we would expect all of those. That's why I talked about asbestos gloves around this asset class.
Yes.
It requires that care and attention.
Heath?
I absolutely agree with what Craig's saying, Rob. I think the main thing is The main thing is actually start to understand what is actually going on, because the thing I can see happening, as I said, is like the idea is translating. The technologists, a lot of the smartest people in the world, are working on actually disrupting the biggest global equity names today.
Yep.
And it starts here. So and I think the great thing about Bitcoin is, so if you start there with a small allocation and education, lots of education about why, before dipping your toe across everything. So understanding why you're doing it, and then when you get in, then you'll understand and you can, the beauty about it, and this is the way I actually started. I just started using it, and then you start to understand what it's actually about in that way.
Okay, great.
Yep.
Look, I'd love to talk for hours more on this. We've got plenty of material and there's been plenty of questions. Thank you to the audience for the fantastic questions. I'm going to ask one more and then we're going to wrap it up. And it's one that's gained some attention over the last sort of 12 months or so. Simply put, how ethical is this investment? Some people have ESG questions around it, particularly around the energy consumption of the area, etc. Just a very brief, I know, again, you could talk half an hour on this topic, but just if you could give a brief.
So how ethical is Bitcoin as an investment? Is that the question? Well, we talked about the social benefit, because we're all living in a first world order. We all have access to banking. So there is some argument that, we saw what's happened in El Salvador.
Yep.
There's a social element. On the E, the environmental, there's a lot of information out there about that it's very energy consumptive.
Yes.
It's about the equivalent of the 70th largest energy consumption country in the world, so about Sri Lanka. That's the current consumption. It is a buyer of last resort of energy, so it serves a purpose for the tail of energy infrastructure finding a purpose, and they're tapping into things like directly into gas. At mine sites in Texas, they can plug straight into the source and use that as an energy consumption. So it's when China banned crypto, 40-50% of global mining occurred in China, and that moved into the United States. It didn't affect the block production of Bitcoin at all. It proved the protocol, energy consumption now is about 60% green and is increasing, but that energy is no different to, think of it another way. If you go to a bank and invest, and put your money in a bank, and then it has to be wired overseas, and you think about all the energy and infrastructure that's required for that event to occur, Bitcoin itself is clearly more efficient in that transfer of wealth. But there's plenty of work to be done there.
Yeah. Heath, just let me frame it to you this way. My assumption is that sort of 4 or 5 years ago, energy consumption and other environmental considerations probably wasn't front of mind for the crypto world. But it does seem to, with the debate hotting up around that topic, it feels to me like the supply side of that equation is starting to pay more attention to those aspects of it, ESG. They may not be, as green as, I can't say the driven snow, something else that's green, the grass, but they're trying to move in that direction. Would that be a fair way to describe it?
Absolutely. And look, I think you see what Craig is touching. Actually, in the Bitcoin network, we've seen this over time. It's actually the network is heavily incentivised to go more green. That's one thing that's very clear, and it's heavily competitive for those providing security, the miners. So there'll be a drive of that. You see this actually, Iris Energy, founded by a couple of young Australian guys we know well, and the brothers there realised a great opportunity actually to greenify Bitcoin. We see a lot more of that energy, and as Craig's saying, I think sometimes people put it out of context in terms of how much energy it does consume when you compare it to other things like air conditioning and other things that we take as being more essential. I think along things like the Filecoin network, what we're involved in, what you can see, you're solving a big issue with data. So moving to an open data network from a closed data network, so that's a big tick on the S. And then as actually that network propagates, content-based addressing leads to a vastly superior way to run our bytes and to hold our data. So over time, that will lead to even better energy efficiencies compared to current cloud. So that's a very, and we think particularly in Filecoin's case, that's very clear for people can see, and it's only a small part of the overall, like the energy consumption part's small, but they've still worked very hard at the protocol level to actually achieve that. So I think everybody's very aware of that. Everywhere we go, that conversation comes up, whether it's equity or debt. We know this because in the Falcon we've got data center equipment, and even lenders are asking us, is this, and the bankers are saying, is this ESG friendly from that side? But I think that's some of the great things about it, that you can find with this decentralisation conversation, that we participate at the local level, which is great for Australia, as well as being, it can be, that they can be marked improvements on today.
Okay, fantastic. We will need to close up now. We've run our time, maybe 1 or 2 minutes over. Apologies for that. I want to say a big thank you to Heath Behncke and Craig Hobart for bringing some great conversation to it. I hope we haven't answered all your questions. I hope we've answered some of the more important ones. There's obviously plenty more to learn about this topic. So thank you all. We have another one on Wednesday, which is a great topic as well, artificial intelligence and big data and how it impacts the investment management arena. So if you like this, even if you didn't like it, come on Wednesday and have a look at that. It's going to be interesting, but I'm sure you all liked it. Appreciate your time for being here, and we'll see you around. Thank you so much. And to IMAP, of course, for having organised this.